Okay, welcome everybody. Hopefully you've got your coffee ready. We're going to probably do an hour or so today. I'll try to cut it short, hour and 15. See what we can do. Definitely not very good. Oh, I can turn this one off. I'm actually not very good at managing time yet, so apologies if I've just kept chatting and everybody's just hanging out and stay until the very end. I appreciate it, but I want to respect people's time and make sure that I don't do that. So welcome. Thanks for joining me. We'll just wait a few more minutes, wait for everybody to roll in here. Talk about the VIX futures today. Exciting day to be talking about the futures, at least for a math geek like me. So we'll get into that in a few minutes here. I had an issue with my voice in the last couple of streams. I did one, I feel like it was Thursday. No, it was Friday. And then I did another one on Saturday or Sunday. Can't remember. It's all a blur. Long weekend blur. But I kind of lost my voice in the second one. So hopefully I'm a little bit better today and that doesn't happen. Yeah, that was unprofessional of me, but what can you do? You try to do two in a row. Maybe that wasn't such a good idea. So I see Cody. Thanks for coming. Wait a few more minutes. I don't know what people's schedule's like, but I notice probably about 5 minutes in, there's a spike of number of people. So I will do a little bit of intro, a little bit of housekeeping, and then we will get to the show. Thank you so much for joining me here today. I really do appreciate the support. So my name's Brent Osachoff. I'm a Canadian, and I'm a former professional golfer, so you will hear the odd golf analogy slipped in there from time to time. I run, I love movies, diehard UFC fan, and I do love to travel, so you'll see this background change throughout the year. So just give me 1 minute here to do a little bit of housekeeping before we get started. If you do feel like you need a little more structure in your investing, I do also manage a private investing community with members from over 65 countries around the world. And it's all centered around both of our diversified portfolios. You can choose the one that best suits your personal level of risk tolerance. There's a daily email sent out every morning with a ton of very useful volatility metrics at the top, which you can learn more about each one of them and start applying them to your own trading. There's a daily article or video where I break down some of the most requested topics from members. And then most importantly, of course, in every email, every day, I state exactly what position each of my strategies will be in, along with all the allocation sizing and risk management that goes with them. I've made it easy to follow so you can get the same consistent performance the VTS community has enjoyed for over 9 years now. No obligation, but if this is something you may be interested in, go to volatilitytradingstrategies.com, click the subscribe tab, and the monthly subscription does come with a free 2-week trial, so you can check it all out before committing. Thanks again for supporting the YouTube channel and spending a little bit of time with me here today. So let's get on with the show. All right, thanks for sitting through that, everybody. I see there's more people now. There is some comments building up there in the comment section, which I will get to. What I typically do is I speak for a few minutes on the topic that I've chosen for the day, and then I will circle back and do the comments, and I will prioritize. I'll go right to the top of the list, and we will get to those at the very top. So if I do happen to forget or don't see your comment, that's happening because for some reason on my end, it doesn't show me all the comments. The only time I ever get to see all of them is if I watch the rebroadcast and I realize I missed a few. So it doesn't show me everything, but I think I get most of them. So if you got something that you feel is a really important question and I don't get to it and I skip over your name, just ask it again and hopefully I'll see it when we get down to the bottom. So we'll just put those comments on hold and talk about the VIX futures. And the reason that I wanted to do this today, first of all, the VIX futures in general, it's just very important for volatility traders to understand how it all works, the expiration cycles, and how those futures directly impact the volatility ETPs that we all trade, the VXX, the UVXY, all the usual suspects. Why today? So let's get right into this. We'll do a screen share. And this is the VIX futures term structure that we are all familiar with. So we've got, this is VIXCentral.com, by the way. Everybody can check this every day. It's got a lot of useful data here. And what we're looking at, this is called the VIX futures term structure. Now, each one of these dots that you can see on this line represents a different month in the VIX futures. So this one here, this is the front month future. Typically, people will call this, I call it M1. So M1, M2, M3. You might hear it called VX1. It's the same thing. It's the front month VIX future contract. And you can see this one is the expiry for the February cycle. This one is March. This is the M2. And then April, May, June, all the way out. Now, the VIX futures term structure is something that is often referenced. And what people are essentially looking at here is they've probably heard somewhere at some point that the volatility ETPs are basing their pricing on these futures. So I wanted to first go over what the futures actually do, what expiration means, and then, of course, I will get into a more detailed analysis of how you actually use them correctly, because there's a lot of misinformation, or at least missing information, maybe not misinformation, but there's a very important aspect of this term structure that very few people talk about, and that's what I'm going to show today. So hopefully at the end of this presentation, you will get a much better understanding of what you're actually supposed to be looking at. So what we are looking at here, like I said, all these futures are for a different month. Now, the reason that I chose today, if I'm hovering over this future, you can see that it says it expires in 0 days. Essentially, that means it's expiring today. And then tomorrow, what's end up happening, this front future will be gone. It will be expired. And tomorrow, this back month future will now be considered the front month M1. So right now, just for one more day, we would call this M2 and this one M3. And then tomorrow, you'll wake up in the morning, this one will be gone, and this will be M1, expiring in March, and this M2 will now be the April expiration. So that's how the cycle works. You can see this green line here. This is the VIX index, just the spot VIX price. Now, the way that these VIX futures work is that only for one day on expiration, at that exact moment that the VIX futures expire, the front month VIX future M1 and this cash VIX index, the spot VIX price, these are exactly the same. So all of these futures converge towards the spot VIX. At expiration, the front month touches and M1 equals VIX, and then it expires. And tomorrow, when you look at this curve, which I would encourage you all to do, you will see that there is quite a significant gap between the front month M1. Remember, this M2 will now be M1 tomorrow. There will be a significant gap here. And that's essentially what people are talking about when they're referring to roll yield, or how the volatility ETPs might potentially, get their pricing, right? It's not based on supply and demand. It's based on these actual futures. So that's the important part. Now, these numbers down here, typically, because we're trading VXX, UVXY, these are all front month contracts. They're volatility ETPs that track the front month of the VIX futures term structure. So this first number, this is what we call Contango. I'm sure you've heard of this in many places. We'll just do a quick calculation just so you can see how this is actually calculated. You may hear people say Contango's 10%, 15%, but you might not be actually aware of how easy it is to calculate that. So if we look at the second month M2, currently, 25.75, front month 21.48. So we can just do 25.75 minus 21.48. Hopefully this doesn't change. So there's $4.27 difference there. And then we just want to know how far above the front month future it is. So 21.48. And that is how we arrive at the 19.87, which is right there. That is the front month Contango. Now, when you're looking at this picture, you might notice, because remember I just said that, actually I will get into that secondarily. What I want to show is where that 19.88% ranks as far as history, and then we will circle back to what happens when the M1 disappears. So if we look at a little bit of data here, this is one of my spreadsheets, we can see that the current value, this was an intraday value, so it's slightly different now, but that 19.51% Contango in the M1, M2 VIX futures is extremely high. It's actually in the 99th percentile. So if we look at a chart of this M1, M2 VIX futures Contango going all the way back to the launch of VIX futures in 2004, we can see that that red line is the long-term median at 6.25. That is the long-term average, marked in the red line. The green line is where we're at right now. 19.51%, basically 20% contango. It very rarely gets this high, right? Again, 99th percentile. So people might be thinking to themselves, well, you probably are aware that the higher the contango level, the more those futures could potentially drift down towards the spot VIX, right? This is the potential in the short volatility trade. Now, nothing is guaranteed. It's very important to understand that just because there's contango right now doesn't mean that the market can't do whatever it's going to do. It's obviously a freely traded market, and regardless of 20% contango, we could wake up tomorrow and the VIX index could be spiking 30%, and short vol traders could have a really bad day. So it's only ever potential. But with 20% contango, which it almost never gets to these levels, people might be under the impression that this is one of the very best times in history to be short vol, right? And it's not entirely wrong. I mean, we do see contango, but it is important to actually have the correct data. So that 20% is actually not exactly the right number that you want to be focusing on. Because again, like I said, tomorrow, this M1 will be gone, right? This will be off the board, and now this is M1 and this is M2. The difference between these two futures starting tomorrow is what the new contango number will be. And down here, you can see it. I'm not going to go through the calculation, but you can do the same thing. How far above this future this one is, that's what contango is. You can see it's only 9.41. Now, that's not terrible. Let me refresh this just so it shows up. That's still above the long-term median, right? So the 9.9, if the market opens exactly where it is, that'll be somewhere about there, right? That'll be the new contango level tomorrow. It's still above the long-term median, but it's nowhere near one of those record-breaking sort of, nearly never touches it type of level. So that is actually quite important for all of us who are trading volatility, because does that make any sense? If you're trading volatility products and you're holding short volatility on Tuesday, near record-setting levels of contango, the highest ever was 33%, but like I said, it almost never gets above 20. But tomorrow, just the passage of one day, contango will drop back to single digits tomorrow. Does that make sense? Does it make sense that our short volatility trade will now suddenly be worse tomorrow than it is today? Let's assume that the market is exactly the same tomorrow as it is today. The S&P 500 opens flat, the VIX opens flat. It's more or less tomorrow is mirroring today. Does it make sense that now our trade has fundamentally changed to that extreme level? Well, no, and that's what we're going to be talking about right now. So that's the first sort of headline number that you might get deceived into thinking if you follow people on social media, for example. They'll just quote, wow, we have insane, massive contango, awesome time to be short vol right now. What they're not factoring in is that these volatility ETPs actually track an underlying index with a set methodology. And this is that index. So I've shown this before. Let me just refresh it. I've noticed sometimes it doesn't show if I don't close and open it. So apologies for that. But this underlying index is what the ETFs are actually tracking. So I've got a little picture here. The blue line is that SPVIX STR index. That is the underlying index for all of the front 2-month volatility ETPs. Your VXX, UVXY, VIXY, SVXY, anything that's the front 2-month contracts, this is what it's going to be tracking. Of course, at different leverage factors, and SVXY is an inverse to that blue line, but this is what they're all based on. So you can see the red, the VXX, is essentially the SPVIX STR index. Again, I hope this is showing up. And then the yellow line is the UVXY. It is an exact mirror on a day-to-day basis. The only difference is, of course, it's a 1.5 times leverage factor for the UVXY. So it starts at a much higher place. It decays to a much lower value. But relatively speaking, on a day-to-day basis, the VXX is 1 times the underlying index, and SPVIX, or the UVXY, is 1.5 times. And the way this works, this is the important part, is that the methodology of this thing is that it actually calculates the changing values of what they call the constant 1-month rolling position. Now, the way that this is calculated, if we look at these front 2-month futures, back to VIX Central again, what we see is that this front month will be gone. And this second month is basically the new M1. So we can tell based on the combination of these two what the actual future is tracking, right? What is this index actually tracking? Because it's certainly not using very much of the front month. That one's going to be gone. You can get the exact value of how much it's tracking of each one of these futures by just going to the iPath website. You can go to ipathetn.com. Over here, you could just type in VXX, and this page will come up. If we go into the index components, you can see that the February future, it only has a weighting of 5.26%. And the back month March is basically 95%. Okay? So if you track how much of each it's holding with the underlying methodology, then you can get what is basically considered this rolling constant 1 month maturity contract. So right now on this VIX central curve, that would basically be right here. It's holding 95% of M2 and only 5% of M1. And of course, I track, I calculate this for the VTS community every single day. So if we go to the beginning, you can see here the daily roll, it's the same 5.26%, right? Now, next month will be different because there's a different number of days in each expiration cycle. And if there's a holiday, of course, you have to back out the holidays as well. But you can calculate in equal increments what this VX30, this is what I call it, the VX30, the constant maturity future actually is. And it's actually right about here. It's nearly all of the M2 right now. So when this front month M1 actually disappears, it doesn't do anything to the actual underlying volatility ETPs. It doesn't do anything to this. This index is still tracking that rolling, always updated 1 month maturity contract. So if you are the type of person that is trading based on the Contango level, well, you're going to be seriously deceived into thinking that right now is one of the highest levels it's ever been. When in actual fact, the underlying SPVIX STR index, which the VXX tracks, the UVXY tracks, it is above average. That VX30 is definitely above average, but it's not exactly as high as you might think. So this is my daily email from just today. Of course, these are using intraday values. But in our volatility dashboard, you can see, this is the general metrics. There's that M1, M2 VIX futures, 1951, 99th percentile. So clearly, all out green light short vol. It's the best time, one of the best times in history to be short vol. But of course, the M1 is expiring and these numbers are completely going to be changing tomorrow. So what I also do, this adjusted M1, M2 VIX futures is really what we're looking at. This is taking into account all of the differences in the decay factor and the expiration cycles, the number of days and all the weighting of each of them. That's what that number is taking into account. So when we look at the adjusted M1, M2 VIX futures, there it is. It's actually down to about 9.2. Now that was intraday. It's a little bit different now, 9.61, but that is essentially what we are talking about. So there is actually quite a significant difference there between the headline number, which would be the Contango level, right? A lot of people just say, wow, M1, M2 Contango's at 20%. That doesn't mean anything because, of course, every day, those underlying products are holding a different composition of those VIX futures. So as of right now, 95% of it is the M2 future. When the M1 disappears, who cares? It doesn't really do anything to the underlying. We're not going to see some radical difference tomorrow with the decay factor than we don't see today. The VXX at 20% Contango is not going to suddenly stop decaying as much when it goes to 8 or 9 tomorrow. That's just how the futures work and the expiration cycles. So it's very, very important that you actually study those futures, understand what they are, and if you're very detail-oriented and very analytical, you might want to actually go and try to calculate them yourself. Like I said, I calculate all these things. I track a whole bunch of data every day, and that's what I share with my VTS community, right? I calculate these numbers. We also have the VX30 constant maturity. It's actually at 25.69 when I sent the email. This is the VIX futures, 25.72. The VX30 is essentially right there, right? And that's what I show people. So the The way that the volatility ETPs will decay, and this is important for you if you're a short vol trader, is the difference between these futures and the VIX index is really what you're trying to quantify. And it's very useful to know that it's not actually measuring this one. It's measuring something that's right there. Basically, one day away from expiration and this one completely disappearing. So when you log in, that's why today I like to do the live stream. It was the perfect day to do it, because when you log in tomorrow, this 20% front month contango will actually be probably, if the markets open the same place they are now, no guarantees, of course, but you might see that M1, M2 contango dip into single digits again. And now that you sort of know what's going on, you know why that's happening, you understand that it's only because of the passage of one day on the methodology of those VIX futures. You understand that it's insignificant as far as us trading goes. It's not like I'm currently short vol in all of my volatility strategies. I've been short vol for a while. I'm long the stock market. I'm certainly not going to exit positions because now the contango level is going to be seriously lower. It's not going to do anything to me because that VX30 contract that we can all calculate, that is really what we're trying to measure. So that's what I said. A little bit of homework for this thing. You check the VIX futures now, look at the shape of this curve, check the contango, look at the numbers, and then tomorrow, it's actually going to be a completely different number. If you have a spreadsheet, you can then go in tomorrow and you can basically, I don't know how many days, let's say it starts at 19 again. Sometimes it starts at 24. Different numbers, you'll calculate, you'll add it up, and it'll be a different daily decay factor. But it's always incremental, same equal increments every single day. It's holding slightly less of the M1 and slightly more of the M2. And as time goes by, we move towards expiration. Happens on this day. The next day, the cycle starts over again. So if you're interested in seeing more detail about this, I've actually done several videos on this subject. If you go to the YouTube channel, what you can actually do, this is just the front page of the channel. If you go to this search bar, you can type in VIX futures, and you can see, this is today's live stream. We're live right now. But I've done several videos that talk directly about these VIX futures, the roll yield, how these can be used as stock market indicators, all of these things. The VIX futures is actually fairly important for us volatility traders. Certainly not the end-all, be-all. It's not like if you understand the VIX futures term structure that you're suddenly going to, be a millionaire trader. It's just an entry-level thing, of course. There's many, many more levels. We can go way further down the volatility rabbit hole, but it is a very good start. And if you don't understand that term structure or what I was talking about today, the SPVIX STR index and the way that it has the 1 month rolling future, if all of these things are somewhat foreign to you, that's fine. Everybody starts at the same place, but you might want to tone down your volatility trading until these things are second nature to you, until you understand it intuitively and all of these things are not going to catch you by surprise, because you certainly don't want to be trading short vol based on a very simplistic and, to be honest, just incorrect assessment of just looking at that front month M1, M2 contango number and using that number. That number changes constantly based on how many days to expiration there are. And of course, I want everybody who's following my work to always have the correct data and always understand how things change dynamically, because nothing is a snapshot in time, right? The VIX futures is a constantly changing market. And so that's how it works. Kind of interesting. And today, of course, being the last day till expiration, this is the big day to really hone in on that process and understand how it all works. So hopefully you find that a little bit interesting. I do, of course. I love talking about the VIX futures. Yeah, like I said, I share all this data with our community, but you can also go the extra mile and calculate it all yourself. It's not the easiest thing in the world, but I'm sure you guys can figure it out. So I also have articles that explain that and whatnot, but I don't want to give you too much homework. That was probably enough there. A good 20-minute spiel on the VIX futures will probably be good for today. We'll talk about this in many future streams, so it's not like I'm going to do this and then not bring it up again. The VIX futures are somewhat central to most of our volatility conversations, so we will definitely circle back. If you have questions, hit me in the comment section. We can answer them now. You can do your homework, check the futures tomorrow, see how that changed, maybe get new questions next week. I'll be doing live streams regularly. So if you don't get your questions in today, there will be plenty more opportunities for you. So yeah, how long was that? 25 minutes, maybe 20 minutes. Good. Getting better. I'm a slow learner, but I'm getting it. So that's about right. Let's get into some questions. I see there's been several. I'm going to go back to the very beginning just to make sure I don't miss any. And yeah, we'll just start in on the questions. So give it 30, 45 minutes. There we go. Hopefully you have a coffee in front of you and can listen in on other people's questions. So when Contango is so high, so VXX rolls over to front month, does that mean there would be less tendency to fall even if current VIX goes down? I'm assuming you mean for the volatility products themselves, that when the future falls, is that going to change the relative difference starting tomorrow going into the future? So let's say 2-3 days ago, going now to today, there's larger changes. And then now, because tomorrow Contango's smaller, suddenly something changed. The actual futures are going to be different, right? The absolute values of those futures, the level of Contango, that's all different, right? It's changing constantly. But like I said, the volatility ETPs directly are not influenced by this change at all. They track that always constant rolling forward 1 month maturity. So every day it is now using slightly less of the front month and slightly more of the back month. And this just goes on in perpetuity. So they are not going to be affected. There's not going to be any step jumps in the price or anything like that. I mean, there could be, but it wouldn't be because of the futures. It would be because the market itself has changed. But no, no difference. It's just, if you're a person who understands the VX30 and you have that calculation, then you're not going to be swayed at all. There's no relative difference day to day. The answer to this is never, but good question. Jonathan, when am I going to YOLO June 100 VXX calls? Yeah. Yeah, I mean, I know you're just joking around, but it is kind of tempting. Sometimes people think, well, you have this idea that volatility is going to spike on us anytime, and look out in the market, look out into the world. It does seem like, I mean, there might be some money to be made by doing that. The problem is our analytical brain kicks in and we realize, well, hold on a second. Volatility does decay by very design. I mean, it functions as an insurance product. And so is my crystal ball going to be good enough to catch that? I don't know. I would say no. That's why I never do it. But hey, if you're going to YOLO some calls, I hope that you just catch one of those big spikes. That would be something, wouldn't it? We can look at, think back in Thinkorswim. That's what it's called, when you can look back at past prices and you can track how the option or the stock would have done. Sometimes I mess around with that thing and I think, well, if a person only bought, say, VXX calls heading into the pandemic, if they got that lucky, that's how people end up getting those huge multiples. Of course, the flip side is the vast majority of the time those trades lose money. So I don't personally do them. My portfolio's quite boring. I like to be as consistent as possible, and no. But yeah, fun. Sometimes I wish I was that type of trader who could actually mentally just kind of do that just for fun. But I already know it wouldn't work out for me, so I'm not going to throw money away. I'll answer that one later, Tom, but that's a good question. Yeah, so I mean, still holding VIX shares, and then there's a follow-up from Jonathan that says you can't hold VIX shares. I assume sometimes people use them interchangeably, VIX and volatility products. They're actually entirely different, of course. The VIX index tracks the S&P 500 options market, and the volatility ETPs like VXX, UVXY, they track the underlying front 2-month VIX futures, and essentially that SPVIX STR index. So they are entirely different. Obviously, there's a correlation there, but yeah, VIX, you can't hold the VIX, right? It's not an underlying product that you can actually hold. You can trade options, you can trade futures, but you can't buy the VIX. So I assume you mean VXX. I am short VXX right now. Essentially, I am long put options on the VXX expiring next June. And I'm also long SVXY, which is an inverse volatility ETP. So essentially, yes, I am short vol. Still holding. What are your thoughts on covered calls or strangles with long stock in VXX? I don't like it because the risk reward profile doesn't pay you enough to do that. So the bulk of your profit when you're a short vol trader is going to come when you catch significant trends, right? When you get into some trades or you recycle the same trade for a significant amount of time and your profit can add up quite quickly. The reason that's important is because, as we all know, as volatility traders, we will get kicked in the teeth every now and then. And you need to develop those larger profits in order to pay for that. The market knows that. It knows that it's an insurance product. So when you're holding your VXX and you're selling your covered calls, trying to generate that premium, you're actually not getting paid enough to hold that position. And then if it goes down significantly, those covered calls just aren't going to provide enough juice for you to make the trade worthwhile because of just the way that it moves around. If it was an extremely consistent, stable, something like a low beta stock, for example, or an index, that's when people can consider selling covered calls because maybe it can cover that risk reward. But even then, it's very skewed. I think in general, anything to do with covered call strategies or holding an underlying position and then, trading your strangles around it, those typically don't work long term because you're not getting paid enough to hold that. You're still susceptible to losses, but you're not getting paid enough on the win side to justify it. So I'm against covered calls in nearly all situations. The only time I sell covered calls is when I hold something that I'm actually trying to get rid of. And if you're doing that, of course, you can sell the covered call at the money and you can get big premiums, or you can sell it in the money and make sure that you get rid of the stock or the index and you get even larger premiums for that. So covered calls is essentially just to get rid of something. It's not a long-term. And you can look at indexes like the put right, the buy right indexes, all of those things do exist in the financial industry. There are institutions that have created those products. You can look at the performance of them. It's just not good. And that's the reason is that you're not fundamentally altering the risk part. You're still on the hook for some of that risk. You're just not getting paid that reward. So I would encourage people to be more trend following and make your money when you can get it, because there's going to be some bad days for all of us. And you have to kind of stash away some money in the event of when that happens. Because it will happen, and we can't. I avoid nearly all trouble. I'm very safe. My signals pick up things very well ahead of time, but we still get kicked sometimes too. So that risk-reward profile is what you're focusing on. Okay, Jim, if VXX is calculated from M1 21 and M2 25, why is VXX below 16? Should it be somewhere between 21 and 25? Okay, so this is the same thing. VXX is not the VIX futures. The VXX is only tracking the underlying methodology. So like I showed in this picture, I'll refresh it. You can see in this picture, the relative changes of VXX and SPVIX STR is exactly the same. But this is a log chart, so you can't see it, but the difference in starting price is absolutely huge. So the absolute values of VXX and all of the VIX futures will be completely unrelated and totally different. It just so happens that right now, when you're looking at things, the VXX is fairly close to the VIX futures. They're both in the, within $10 or so. So it gives people the impression that these two things are supposed to be the same and supposed to be tracking. Those absolute values mean nothing. The VXX could do a reverse split. It could go to $100, and that wouldn't mean anything. The underlying relative day-to-day changes is all we're looking for. And the VXX tracks with near perfection. I mean, there's times when it can deviate, but with near perfection to what's called its underlying indicative value. And that value is the day-to-day tracking on a one-day basis of that SPVIX STR index. This index. This is the VXX. Now you'll notice the prices are not the same. But again, it's the methodology. It's holding that always constant 30-day or 1 month maturity VIX future and constantly rolling that forward. And the prices change based on the value of that contract, of that rolling 30-day, 1 month contract. So no, it's a little bit deceiving because the prices are fairly close now, but the VXX and the VIX futures are completely unrelated as far as nominal value. It is just a relative thing. Same with the VIX index. You didn't ask that specifically, but it's the same with the VIX. A lot of people ask the exact same question. Why is the VXX not moving with the VIX? Well, it's because these are all totally different products. The VIX index tracks options on the S&P, VIX futures, volatility ETPs all have different starting points. They do reverse splits all the time. Totally different nominal values. Don't get confused there. It's just sometimes it's deceiving because they can get very close, especially, several weeks ago. The VXX, I had a lot of emails because the VXX was seemingly the same price, and that really messes people up. But that's not what's actually happening. You know what? I think I missed. My stream jumped again. I hate when that happens. So give me a second to... I did that one. Jim, oh, you're answering that question. Yep. Huh. Answered it quicker than I did. I tend to be a little bit more wordy. It's just my personality. I can talk a lot, as people probably know. All right. This is a continuation of the same question. Thought it equals that. Obviously, it does not. Yeah, I think I covered that. But yeah, very good question. And a lot of people have that same question, so I'm glad you asked it. But yes, it is different. Victor, thanks for joining the stream. What's the math formula for calculating the M1, M2 adjusted? I know that the M1, M2 regular is, yeah. The regular Contango is super easy. The actual adjusted M1, M2, obviously it's a little bit more complicated. You have to understand the, what's going on, how it all relates. Not that one. Maybe I'll look in this one. There's some math involved. I mean, you can do it. Just think about it intuitively, right? What are we actually tracking? We're trying to figure out what the combined future of, say, these front 2 months are. This one is 1672. This one's 1732. What is the combined future based on the number of days to expiration and how fast each day that it ticks forward from M1 to M2? So, of course, as it turns out, this one is 16.79. It's actually very close here. All you do is you basically do a simple calculation of the percent of days in the roll. So this future roll is important. Like I showed in my chart, it was this month it's 5.26. That's different every month depending on how many days in the cycle. So 4.5, another 5.26. There's a 5 month. There's a 4 month. It really, really depends. You can see sometimes it starts at 25 days, sometimes 19 days. But, I've shared this stuff. So on this article called VX30 to VIX roll yield, you can actually go in there and you can get the math. Now, I realize almost nobody's actually going to go do that. So it's much more important just to understand conceptually what's going on. The fact that you understand it's a combination, it's an adjustment there, you're already way ahead of the game. So as far as calculating it, this is something that I do because it's directly influencing my trading. I need those numbers. But yeah, you could do that if you wanted. So essentially, you're just M1 multiplied by the number of days times how much decay is actually the equal increments of decay, and then M2 multiplied by the number of days and the increments, and then you just combine the two. That's how that works. So there is a character limit here. Yeah, I can see you've had a couple. I don't know. I think it's 500. But, I mean, it's live, so don't hit me with a novel. I have to answer them quicker. So I understand that the VIX is only an index based on S&P options. VIX, ETP, ETN are based on VIX futures. That is correct. I'm going to skip ahead because I think you're still going. And by extension, VXX, UVXY, and their options are based on a derivative, supply and demand. and by extension, VXX and UVXY and their options. Well, options always have a market maker, right? So there is always going to be a bid-ask spread. There has to be a market there. It's a little bit different because these volatility ETPs can just create shares. I mean, the option market maker probably can't, but it gets a little bit weird that while there is an options market and it's an open market, part of that is, there should be volume there because it's essentially based on the VIX futures. It's not supply and demand. So the VXX and the UVXY, they're not moving based on how many people buy those products. They're moving based on that 1 month rolling contract and how that moves up and down. So if that VX30 contract is going upwards, then the VXX and the UVXY are going to increase in value. If it's going downwards, then that's good for the short vol trade. We always want those futures to be drifting lower. That's why it's better for the short vol traders if the VIX index, right, that green line on the VIX futures curve, it's better if this green line is below the VX30. So the VX30 is right there. That's significant gap right there. That's, pretty decent roll yield there. This is actually better. We want this to drift lower. But it is important to remember that while the volatility ETPs themselves don't trade based on supply and demand, right? They are just tracking the underlying index. Those VIX futures are a freely traded market. So it's not like supply and demand is completely removed from the equation. It's just on the actual ETPs. That doesn't matter. It doesn't matter if I go out and buy however many shares I buy. It's not going to affect the price. If I do the same thing in the VIX futures market and those prices are changing, yes, that could definitely do something. Hopefully that was in a roundabout way. Victor, I wouldn't confuse the spot VIX with the VIX futures. Yeah, they're not, they're different all the time except on the final expiration day. Remember that front month future will converge to the spot VIX at expiration. But at all other times, there's really tracking the differences between them. One of them, the VIX index, is tracking something different than the VIX futures or just a freely traded market. So they are different. But that convergence is part of the equation that we need to understand, that for that one day, and the VIX futures are converging to the VIX. Now, I got to be careful the way I say that, because whether the VIX goes up to meet the futures or the futures come down to meet the VIX, well, that's a freely traded market. That will depend on all the real money activity out there. But there are some things that are not supply and demand, and the price of the volatility ETPs is one of them. All right, what do you think of a recent inflow in long volatility products? Yeah, I've seen the charts as well. In the last couple of weeks, certainly in the last week, the inflows to UVXY has increased dramatically. Is it possible to squeeze VIX to the upside? I've read some articles suggesting as a possibility. So you'd have to define what you're trying to squeeze. If you're trying to squeeze the VIX index to try to maybe make money in the VIX options market or something, I would say almost certainly no. It would take a tremendous effort to do that. It's the VIX index. Remember, it's based on S&P 500 options. It's not a tradable instrument. It is just a statistic representing the buying and selling of options on the S&P. So if you're trying to game the VIX, which is how it's always worded, could we make the VIX do something? No. It's an insanely large market. So if you had these, I think a lot of us made that mistake of thinking, oh, the Wall Street bets, they've got no money, no capital. How could they influence anything? Well, it turns out if there's a certain situation with super high short interest, low float stocks, smaller stocks, yeah, they did a pretty great job on GameStop and things like that. But doing the same thing to the VIX index, just functionally wouldn't work the same way because it's not a stock. But also, it's just a much larger market. And the stories they're for eyeballs and they get people interested because we just saw GameStop and we just saw all these AMC. And so, it's a good way to get people to read your article. But no, squeezing the VIX is an entirely different animal. And then if you're talking about the volatility ETPs, of course, those are just trading based off the underlying VIX futures. Can you game those? Could you purchase enough of those to maybe make the VXX. Again, you're talking about markets that are significantly larger. Now, could it happen? Sure, I guess. Like I said, we've all made that mistake in the last couple of months, thinking that this is just a few people on a website, sharing ideas. Turns out you get 5 million people in the same chat room, and it doesn't matter if they all have small accounts, they can do some things. So it's something to keep an eye on. But the VIX futures market, the VIX options, S&P 500 options, these are pretty large markets, and there's a lot of moving parts there that I think a lot of people wouldn't understand. It's not going to be as easy as just saying, look, short interest, let's buy GameStop. Manipulating the volatility market is a much higher level endeavor. Yeah. You can go through that. I mean, I do it every day and I share it with the community. It's just something that it's part of my daily email. But yeah, sure, you can do that yourself. It's not advanced math or anything. It's actually quite simple. It's just people don't go through the effort to do that. So whether you want to or not, it's entirely up to you. Hello, I think I should sell the VIX June future. It is near its high. It's near its high. I don't know what that means. The VIX futures can go extremely high and extremely low. So where's the June future? I mean, do you mean it's high as in peak on the chart? Because this picture can change dramatically, right? It turns out that the June future is the highest one, but you got to look at each future as an independent contract, right? This is going to be fluctuating up and down, and so are all of these. So the actual shape of this curve, those futures can reorient themselves, and it's not based on, well, this one's really high, so I'll sell that one, and this one's really low, so I'll buy that one. It's not based on that at all. I would think that, I'm not saying that doing that wouldn't work out, but I think the reason you're saying that it's somehow high compared to what? I mean, relative to what? It's not high at all compared to its all-time high. It's not low compared to its all-time low. It's just, that's what the VIX future is right now. If you wanted to have a strategy trying to capitalize on some of these trades, it should probably be based on something that's not an arbitrary nominal number, right? That's just the absolute value of the future today. That when something's high, it doesn't mean it has to come down. When something's low, it doesn't have to go up. So I would focus on the reason, not the price. Why do you think the VIX future is a short, the June future? Not because it's high. Why? What is the reason you think that future will move? That's what your theory should be based on. Morgan, thanks for streaming. Curious about your own journey into investing and what made you start studying, applying volatility strategies. The low correlation pulled me in. Yeah, that's a good point, that last bit. For me, everybody knows this. I retired from golf as a professional golfer, retired in 2005, and essentially just started options trading. So I didn't really go through a stock trading journey. I have traded stocks, but I started with options because I have a math background and options just resonated with me. So that's where I started. And I was trading options for, 5-6 years. And then the VXX launched in 2009. I was aware of it because I was a derivatives trader. So of course I knew it was there, but the volume wasn't great on it initially. And there was a lot of confusion, including on my end. I have a video actually showing some of my first VXX trades back in 2010, where I actually went into my broker statements and showed those trades. I didn't really know what it was either. It took me a couple of months to figure it out. But then, starting in 2010, now we've got this whole new frontier of volatility ETPs. Of course, a derivatives trader, like I was, is naturally going to gravitate towards anything volatility related. So for me, it was just it just resonates with me. Everything is based on things I can calculate. I've always said that if I can't model it in a spreadsheet, I can't trade it. It's why have I never bought Bitcoin? Well, it's not like I don't want to enjoy playing around with Bitcoin and perhaps make some money. It's just that I can't model it. It's not like an options trade. It's not like a volatility trade where I can quantify the probability that it's going to do something the next day. who knows, right? With Bitcoin or gold or any of those things, even stock trading, very hard to quantify now that we are not in a value fundamental environment. We're just in a whatever it is environment. So that's probably the reason. For me, like you said, the low correlation, that attracted me as well. That's why I liked options trading, because it's essentially a risk management tool. It's not a speculative tool. That's just how some people use it. But you can structure your trades any way you want. So you can make money in a flat market. You can go inverse the market. That appeals to me a lot, in that it's not the binary long stocks or short stocks. Options is a whole world where you can get so much nuance there. You can adjust your correlations and your leverage factors, everything. It's just, once you get into this market, like it sounds like you have, you can't really go back to the old way of investing of just, I think X, therefore Y. It just, nothing I do is, here's what I think. Here's what my gut is telling me. It's all quantified. I can model everything. And that's why I trade volatility. Sounds like for you as well. That's the appealing part, is that there's some truths that we can actually arrive at. Why is Apple worth what it is? Why is Apple's PE ratio, why is its PEG number so radically different than Tesla? They both make interesting products. They both could make a case that they're changing the world. They both could make a case that they're, software companies or whatever it is. Why is one of them, the valuation is just crazy? The other one has a relatively modest valuation. Who knows? Can't model that. Nobody can show me the numbers. Okay, why is Tesla worth so insanely more than Apple as far as, fundamentals? The price of Apple compared to how good the business and how much money it makes compared to Tesla. You can't model that, but I can definitely model the probability of a short VXX trade being profitable tomorrow. I can definitely tell you the answer to that question. So that's why I can quantify everything. Doesn't mean I'm always right. I have losing trades all the time, but at least it's coming from a place where I can actually point, I did it because of that reason, right? Not because my gut told me to. Is holding deep in the money VIX leaps a good way to mimicking owning VIX if I prefer to use VIX rather than VXX as a hedge? Yeah, always, if you are doing that, you want to do in the money, like you said, you want to increase the delta as much as you can. You have to understand that there's very little difference between VXX, the VIX options, between SPX put options. These are all insurance, and they're all relatively the same, right? There's slight differences based on, like, you could track the VVIX and see where volatility on the actual VIX is. Maybe there's better times than others, but essentially you need to look at all of these things as the same fundamental product, insurance. That's what it is. The VXX decays basically, not because it's designed to do that, it's just that's what happens to a constantly rolling, basically short Vega or long Vega trade. That's what happens. Long VIX options, leaps in the money, you're not doing anything different fundamentally than you are if you just buy put options on the S&P 500. They're both going to decay the same way. The chart's going to look the same, right? For that option. The VIX index, of course, looks different, but the value of that option is going to decay on you. Basically the same amount as the other ones. So it doesn't matter what you do. If you're doing that deep in the money, sure, if you have some portfolio you need to hedge, that's a way you could do it. I think buying very small amounts of VXX or UVXY specifically, that's also a good way to hedge. But those are going to be losing positions. You're just hoping that the portfolio itself, maybe you sleep a little bit better at night that you hedged your portfolio. But there's no fundamental reason why in the money VIX leaps would work any better than just buying VXX or UVXY. You just have to calculate how much of your hedge versus the size of your portfolio. Hedging is not easy. You have to calibrate that ratio quite accurately, or you will end up, if your hedge isn't enough, then something like COVID happens and you get destroyed. If your hedge is too much, well, we know it bleeds over time, and your portfolio is not going to make enough to pay for all this hedging that you're doing. So hedging is a real science. I mean, it is not easy to hedge a portfolio. I personally don't hedge anything. I just do it through diversification and position sizing. But yeah, hedging is Hedging is tough, especially on decaying products like that you better get it right, or you might have a couple extra holes in the boat and you're just leaking constantly. If VXX goes to 0, will it be reset to some higher value? Let me close this spreadsheet that I have open and open my other one. So this will take a few seconds here. But essentially what the VXX does is all of these long volatility products, what they're going to be doing is called a reverse split. So let me just wait for this thing to load here. The VXX right now is trading at about, last I saw, 1583, something like that. When it gets down to a level that, say, $8 or $9, there's no set value, but once it gets down to a certain level, it will do a reverse split. So let me just check if I'm screen sharing here. Yes. All right, so this is the VXX, and you can see the splits there. This is a log chart, easier to see. And you can see that every so often it does one of these 1 to 4 reverse splits. What that is when the product decays, right? So if we start at something like 1583, right there, that's today's price for the VXX. The decay factor for the VXX every day is that much. Okay, so we can basically get a pretty good idea of when this product is going to do a reverse split. So let's just say it's going to do it at 9. So in 236 trading days, if it goes by absolute long-term averages, obviously we can get more or less decay, right? I've actually did a recent stream where I was showing these things, but this is the daily decay of VXX. You can see sometimes it's significantly less, sometimes it decays far faster, but the long-term average decay is a number that we can calculate, right? We know that. So this is the expected path of the VXX based on long-term averages. And when it reaches about that 9 level, which is, like I said, about 240 trading days from now, so almost a year, maybe next January, we might be looking at a reverse split. So then what will happen is it won't change anybody's value. If you're holding it, it doesn't really matter. But the VXX will do another probably 1 to 4 split, right? So if it's priced, say, at $9, give or take, then it's going to be $36 after they do that reverse split. And they will be constantly doing this. So you can see the UVXY there next to it. The UVXY has done several splits, and a couple of them have actually been significantly larger. So that's what happens with these volatility ETPs. That's why when you look at them on long-term charts, they look like, well, it should be at 0, right? Obviously, the long-term charts look completely diabolical, especially if you view them not on a log chart. If you look at it just on a price chart like this is, VXX looks like, well, shouldn't it have been 0 15 different times? Well, yes. But every time they do a reverse split, they get to actually self-correct that thing and bring it back up to a price that's tradable, and then rinse repeat. So that's what's going to end up happening. UVXY, of course, it's a 1.5 times leverage, so it will reverse split sooner, and it's already very low, so it's getting there already. This decay factor in the last month has been significantly more than the long-term average. Long-term, the UVXY decays about 2.1% a week, but lately it's been more than that, so reverse split might be incoming soon. And yeah, they'll just take the price up and start all over again. So that's why when you look at a long-term chart, we always say, well, look at this product. It launched at 650 million and now it's $10. It wasn't actually ever that price. It launched at 100 or whatever it was, 10 for the case of the old XIV. But based on all the split adjustments that we have to do, it can look some pretty insane numbers in the past. Supply and demand present in TVIX because CS no longer creating units. That sounds like a good answer to somebody who probably asked something previous about, is it still okay to trade TVIX? Hans is always answering these questions very well. I'm guessing. I can't see it. My stream jumped again, so I probably missed a million questions. And there's so many. I mean, we're never getting through these. We've all been going for an hour. Not even close. Did that one. Sorry. This is a lot harder than it looks. On my end, it looks probably a lot different than on the YouTube channel. Maybe that's it. Why is the VXX, UVXY futures prices and VIX deviating so much? Yeah, I think I answered that already. It's because they're not the same product. They're completely unrelated. It's just, it can be deceiving when the prices are near. But remember, it's just the one-day rolling methodology. It's not actually the nominal values. So the VIX has, price-wise, has nothing to do with the VXX or the UVXY. The UVXY could do a 10-to-1 reverse split and go from, $10 up to 100. And then what? Then nobody's going to be confused that how come the VIX is at 20 and the UVXY is at 100. It would solve the confusion. Unfortunately, when everything is sort of within $10, it starts to become, well, how come that's moving this way? And, just remember, these are entirely independent. You're looking at relative changes, not nominal price values. Those can change dramatically. Of course, TVIX went to 1,000. Nobody confuses the action of TVIX with the VIX index because 1,000 compared to the VIX only went to $86 or 86%. Nobody was confused there. But lately, that question's coming up an awful lot. Oh, there we go. I've kind of caught up. I've got tons to go here. Try to speed up a bit for you. All right. Here we go. You've spoken about VIX ETPs termination events a couple streams ago. What are your thoughts on risk of them decoupling from the underlying index, like those gas ETNs did? So it can happen, but essentially there's market participants, authorized participants, who are basically charged with keeping the volatility ETPs in line with their indicative value. So if you ever wanted to see if there's any deviation, you can go on any website or just go on Yahoo, and you're looking, if it's VXX, just look at the index called VXX-IV. And you can compare that price with the VXX price, and you can see that they are actually quite similar. Not exactly intraday, but you really should. Let me just do that for you here. Screen share. Forgot. So I'll just use Yahoo Finance, a public website here. So you can see I typed in VXX-IV. This is the intraday indicative value of VXX. You can see it says 1560. Well, the VXX should be very close to this price. Now, like I said, intraday, they are still managing this. So if there's 900 million or, $1 billion ETF, there's going to be slight deviations. Nothing to be terribly concerned about. And of course, it will reset, and they're constantly working and paid quite well to make sure this functions smoothly. But there have been times when it can deviate substantially. Now, typically, that would happen it happened on TVIX back in 2012. There was actually a pretty legendary period where it was 30-40% difference than the indicative value. So significant decoupling can happen. But what I would suggest is just anytime it happens, I would move out of the security, right? So if you're trading the VXX or the UVXY and you notice that it's deviated substantially from its indicative value, you probably want to get out of that trade because it's representing, the authorized participants or the share creation. Something's up there and you don't want to put yourself at risk. So anytime you notice a deviation, probably time to move on to different products. And for our purposes, I assume you're a short vol trader as well. Don't forget, there's always VIX options, futures, there's index options. There's lots of ways that we can represent these trades. You don't have to use the UVXY. And then if it breaks, well, wild, wild west, I'll just see if it works out for me. I'll just try to stay ahead of the broken instrument. No, just leave. Just circle back when it's functioning normally. The vast majority of the time, the supply and demand is not at play here. Nothing's changing. They're indicative and the price is so close it doesn't matter. There are times when it might deviate. And if it does, boy, just move on. Go to something else. Yeah, this is the one. I don't even know what Tesla's. PE itself, I don't even know if people look at that anymore. I'm not really a fundamental guy. I think that's pretty limiting. But it doesn't matter how you value a company, right? If discounted cash flow models or whatever you want to do, there's no justification for things like that massive decoupling. That doesn't happen in our world of options and volatility. We can always quantify what's going on, and we can always structure our trades to capitalize on our market thesis, right? Like I said, it doesn't mean we're always right. It just means that there is a radical difference between trying to trade Tesla and trying to trade VXX. These are entirely different. One of them, the VXX trader, can quantify everything they're doing, and they can come up with actual right answers. Tomorrow, here's what's most likely to happen. I can tell you which position is best to go overnight through based on calculations. How could we possibly ever know that about something like Tesla or Bitcoin or anything that doesn't track? You can't model it in a portfolio, in a spreadsheet. So yeah, what would you say? 1,200? Sounds about right. I guess the story is they're always pricing the future. It's always the future. And then the future comes and, okay, now we're going to price the next future. And it's always a constantly moving, they're just moving the goalposts constantly. And hopefully you've been on the long side keeping up with it, because pretty crazy. There's a lot of people answering other people's questions, which is awesome to see. I know there's a lot of knowledgeable people in the chat. It just might throw me off. So if I stare into dead space for a few minutes, it's because, I can see other people trying to help me out here. And fortunately, I don't have to come in and start regulating, because all the answers you're giving are correct. So that's good to see. Don't start giving answers if you don't know what you're talking about, but you're helping out a lot here. How do you select strike price when shorting VXX puts? So I have two strategies. One is the long VXX puts way out into the future. For that one, I'm targeting a certain leverage factor and a certain calculation of how much capital I want to put at risk. So our most recent trade in our tactical vol, we did the slightly cheaper options. We paid about $660 for those prices when the VXX was at $1650. That means that ratio is actually pretty wide, right? So the trade is much smaller as far as magnitude. The trade two before that, we were at a factor of about 75%. So it was a more leveraged trade. So I just select based on what my models are telling me about the current viability of a short vol trade. Not all environments are the same. So by using options, I can adjust based on my models. Like I said, very important to be able to actually calculate these things. But I can see when the more ideal times to short vol are, and I can either go more aggressive or more conservative on the strikes that I'm choosing. So when you're saying short VXX put, the way that it's exactly the same. I'm essentially balancing what I've calculated, the potential decay of the products, right? I wouldn't have sold an aggressive one 2 weeks ago because there was massive volatility crush built into that. We had the, if we go back to my indicators from my daily emails, the traders VRP and the simple VRP, if those are through the roof, you've got a situation where you could get major vol crush. So if you're selling put options on VXX, it can go several dollars past the strike. So of course that has to be factored in. The second thing that I have to factor in is the rest of my portfolio. I have to calculate the beta factor of my portfolio versus the S&P 500 and make sure that when I'm offsetting two positions, right, long stocks, long or short vol, that portfolio versus short VXX put options, these are mathematically inverse of each other. I have to get that calibration correct, or I might end up, like I told the previous person, if you don't get that calculation right, then one of them can lose more than the other. Maybe one of them doesn't pay off the losses in the other. So there's a lot that goes involved in that. So right now, we're at the 1550 strike, which is aggressive, definitely aggressive, but that's because the overall portfolio is also aggressively allocated. And short vol right now is, like I showed earlier, the adjusted Contango and the VX30 to VIX roll yield, they're not completely off the charts. So we're not expecting, massive decay in the next couple of weeks. That's kind of already happened. It could. Like I said, everything is variable day to day, but my calculations say that things should start to level off a little bit there. So we are in an aggressive short put right now. We're looking for an expiry somewhere around 1550 would be just perfect. That sounds like an interesting one. I think this is the first part of that. VXX is based on VIX futures, while the VIX index is based on S&P. And then later you said both VIX futures are still up today. So what have we got? We've got the VIX, which is up 5.7%. And we've got the VX front month future essentially flat. It's at 0.19% up. So that is actually a really good example of the VIX index being different than the VIX futures, right? They're all different. These are based on different things. The VIX futures is a freely traded market. The VIX index is a statistic based on S&P 500 options. They can go up, down, different. One's up 6%, one's down. It can totally change. And today is a good example of that, where the VIX index is up pretty substantially, nearly 6%. Now, that's because of the long weekend. But yeah, those numbers don't have to match up at all. Long-term correlations are very high within all the volatility metrics, but day-to-day we can see significant deviations. Always important to know your underlying and what it's tracking and how it works. Don't let relative changes between all of the different, like VIX, VXX, VIX futures, don't let the changes there fool you. Believe me, as many times as people tell me there's manipulation involved, I can tell you that all of these products, the VIX index, the volatility ETPs, VIX futures, they all function exactly like they're supposed to. Aside from some very rare occasions when there's something going on, the vast majority of the time they're doing exactly what they're supposed to do. So if you look at it and you say, well, how come the VIX is up 5 and the VXX is down, or whatever it is, there's a reason. There's an actually fairly simple reason, and you can calculate it yourself if you want to go through the numbers. How do you scale your strategies? Position size, oops, it covered up there, versus diversification. And how do you manage drawdowns? Well, the whole thing kind of wraps into the same answer, is that through proper conservative position sizing and each individual component of my portfolio having safety positions available, that's how we manage the risk. So this is the unleveraged portfolio. I call it the total portfolio solution. And it's made up of 5 strategies, okay? 5 different sort of independent from one another strategies. The first one, 20% allocation, you can see has stocks, bonds, and gold. So this, as a standalone strategy, has aggressive and conservative positions, safety positions in place. The second strategy, which is totally independent of the first one, I don't do anything in this one because this one's in something else. These are totally independent of one another. This one also has ranges of safety and different variations. This one as well. Now there's 5 positions. The defensive rotation, 4, equities, treasuries, stocks in the middle. That's a little bit different than short vol here, long vol here, gold over here. That's how I manage the risk, is that each individual strategy is doing its own thing to move to safety whenever there's trouble. And then when you put it all together in the same portfolio, that's how we manage the risk, is that there's never going to be a time when the entire portfolio is sort of doing the same thing, right? Now that we have the vol trend, that one's always going to be inverse a couple of the other strategies. The defensive rotation, when the MDY strategy is actually in gold, well, the defensive rotation will be in utilities. Those are not directly correlated to one another. When the VB threshold is in a certain position, maybe it's in short volatility. Well, the other ones, the vol trend, might want the profits to go the other way. So that's essentially how I'm doing it, that I've created independent standalone strategies with obviously in mind how they all work together. But no need for hedging when we do that, because first sign of trouble, we move out of all aggressive positions. And it's very important to understand that in order to make money, you have to risk something. So I start at the baseline level of risk that, look, at some point, I'm going to have to go long equities. I'm going to have to short vol, right? You have to do that. It's never safe. It's never totally protected against sudden spikes, but you have to do it, right? You got to put money in the market to make something. But I just make sure that when that money's in the market, I'm available on a single day. If something happens overnight, tomorrow I can move completely from my aggressive into my safety in one day. And I don't have to sit there and watch a 3-week drawdown. I can just say, well, didn't see that coming, got hit in one day. It's never fun when you get hit in one day, sort of out of nowhere. But I can completely shift the bias of my portfolio in no time at all. So I favor that system much more than trying to calibrate hedging in a buy and hold portfolio. Hopefully that made some sense. Wow, we're getting near the end of these questions. Coffee's getting cold, so time to start winding down. Victor says, do you think the VVIX metrics could be used to predict VIX spikes like the one on June? No, I do not. I do show the VVIX. I do talk about it sometimes. There's some data to be shared. There's a few interesting things about the VVIX. But in general, the VVIX and the VIX itself are, in my opinion, probably two of the worst indicators as far as actually trying to position trades, right? They're just conceptual things that you want to keep an eye on. You definitely want to know what they are. You obviously do. You said, volatility of volatility, essentially what the VVIX is. You want to know what they are. You want to be aware of how they're moving. As far as actually allocating capital based on levels of that, I would never, like the VVIX, for example, has increased in the last week and a half or so. It's kind of reached a little bit of a bottom and now it's rising up again. There are people who might think, well, that's got to be a sign that the markets are ready to, go down again. So the question is, am I going to actually use the VVIX, which is clearly signaling some risk? Am I going to use that to influence my portfolio and how I'm positioned? And the answer is no. It's just not nearly a good enough indicator to base decisions on. It's very hit and miss. The VVIX could go to 140 and the stock market could still be at all-time highs. And there are other times when it looks like it's the perfect indicator. It looks like, wow, if the stocks crash next week, like let's say, or later this week, there are going to be a lot of people pointing to the VVIX and saying, well, look, there were warning signs. It went from 107 all the way to 127. Clearly there was a warning sign, right? Well, yeah, in hindsight, sometimes it does appear to be like that. But there's going to be so many times where the opposite is true, where it's showing what you think is a warning and it just doesn't materialize. Same with the VIX. Just because the VIX is doing certain things, it's really not a very good indicator to be basing trades on. That's why I get more to the heart of the VIX futures term structure, the relative changes between the metrics, not the number itself, the momentum differences between them, how fast are they moving, things like that. The cash VIX, the difference between the VIX 9-day index, the VIX 30-day index, the VIX 6-month index, measuring the relative changes of these metrics is something that I do base actual real dollar trades on. But the VVIX itself and the VIX especially, those two, no. I get why you're asking, because recently it certainly looks like it might be signaling a warning. But in my opinion, if you wanted a tip on the VVIX, really the only practical use for it is if you see a significant market crash. Obviously, volatility is going to be through the roof. You might see, and this is more than hit and miss. It's actually a fairly predictable pattern. I don't know what percentage. Let's say 70-30. You might notice the VVIX coming down quite quickly, even when the VIX or the S&P 500 hasn't fully reached the bottom yet. And in that sense, the VVIX could be used as a somewhat contrarian indicator to try to find a level for a potential bottom in the market when the selling might be just about finished and then maybe the market is ready to bounce. You might see some signals in the VVIX a little bit before the market. But again, basing real dollar trades on a metric is an entirely different ballgame. I mean, am I going to exit my portfolio right now because the VVIX is sending a warning sign? Can't do it. It's just too hit and miss. So you're fine to ignore it. If you don't focus on the VVIX at all anywhere, you're not missing out on anything. I really think you could ignore the VIX and the VVIX and you'd be just fine. I just went through this in my portfolio. Essentially, we trade only the most highly liquid, we trade indexes, essentially. For the vast majority of our trading, it's indexes and vol ETPs. MDY stocks, treasuries, IEF, 7 to 10 year treasuries, gold. This is all volatility related. These are all large ETFs, treasuries, short vol, stocks, treasuries, long vol, and then utilities, treasuries. And then, of course, we have the options portfolio. We have a leveraged version of that portfolio as well. But essentially, we are just trading stocks, bonds, gold, utilities, options, and short vol. That's the list that we go through, and we hold them based on the preponderance of evidence of all of my volatility metrics and what they're pointing to. And, more often than not, I'm right. Nobody can get it perfect. Obviously, losing trades are part of the process, but your goal is to manage risk as best you can and have more winning trades than losing trades. And then you just do that for 30 years and you're going to be very happy with the results. So that's kind of what I do is I've just structured a very safe, balanced portfolio that somewhat hedges itself. It's not protected against, sudden spikes, but anything that is visible early on or as it's developing, we can see those and we can exit out. Nobody can predict if we wake up tomorrow and we have, an epic stock market crash. Nobody can predict that. But yeah, we just use regular normal instruments. Best tack for the price. Yeah, assuming if you mean hedging. You got to remember, though, that's not technically true. I mean, of course, the VVIX decays faster. So if you're buying long UVXY, that's going to be a better portfolio hedge than long VXX. But certainly you'd want to adjust your position sizing. You're not talking about using 2% of your capital on VXX or 2% of your capital on UVXY. You would know the underlying beta factor of your entire portfolio, and you would match your UVXY to that position. And then if you were using VXX, you'd have to use, 33% more of the VXX. You'd have to have more shares and a larger allocation. But you wouldn't be comparing 1-to-1. So there is not much difference between UVXY or VXX when it comes to hedging. They both can be used just in different amounts or a different allocation. UVXY, you wouldn't need as much. More convexity, it's a faster moving product. But yeah, you wouldn't, with VXX, you could do the same thing, just buy more of it. Last question. Easy one to answer. Do you code at all or use any APIs for your calculations? I was thinking about writing a Python script to read the emails you send out and automate the necessary trades. Short answer, no. I'm not computer illiterate. I mean, I've been working with computers for 15 years, but I make them work for my purposes. So I'm decent at Excel because I've been using it for 15 years. But that's it. I have no programming ability. I don't use any APIs. I would love that if, I've often thought about trying to hire somebody to help with the business. If I were to do that, it would probably be with somebody who actually has that background because I can handle everything. That part of it, I think would introduce a whole new aspect. I actually have, I have many websites, of course. I've shown them all. My main one, Volatility Trading Strategies, if you're new to the chat here. I've got this is my main business. VTS Options is me as well. VTSoptions.com. That is also me. This is purely options trading. I've got Prosperitas Financial, which is my consulting firm where I work with hedge funds and, private family offices and basically allow them to use my strategies with their client base. And then I've also got one that I'm working on, or that I was going to work on, called VIXsource.com. And essentially what this website was supposed to be was some of my more useful and interesting metrics, basically a live dashboard updating all of these things. Now, I have, like I said, I have nearly zero computer skills. So I just kind of have the website sitting there and nothing's going to come of it because I couldn't possibly program anything. But that's something that would kind of interest me. So it sounds like you kind of know that world. You can program in Python. That's impressive. There was a time in the past when I kind of considered doing that, but I don't know. I feel old. I mean, I'm old. I'm old school and I just do everything manually, and yeah, not for me. But I've got plenty of ideas that I could use a programmer. I could hire somebody. I've always thought of, having some type of, because I've got several strategies, having some type of portfolio builder where people could input the percentages that they use and it will spit out, what's your Ulster Performance Index, what's your correlation to the S&P. All of these things could be quite interesting for me and my business, but I have zero ability to make any of it happen. So it is what it is. My business functions just fine. People don't need to know that on a second to second because we only make trades once per day anyway. So it's not like it would help at all. It just would be kind of cool to see those dials moving around. It'd just be, it's a novelty. Essentially, it wouldn't improve my business. It would just kind of look cooler. But I wish I had the programming ability to make what I do look cooler. Because I think I've got some good data and some good information, but it is what it is. I don't know how to program. So, and my websites look like children made them. I've never hired anybody. I've never had any help. They look terrible. I mean, this is a person's actual website. I mean, this is quite embarrassing. This is my website. I mean, I basically put this together using Wix.com. Pretty silly, but yeah. It is what it is. So hopefully everybody kind of learned a little bit about the VIX futures today. You've got a little bit of homework. Remember, you can check the VIX futures curve right now. Remember that front month February is using 5.26% of the front month M1 and basically 94.5% of the back month M2. And overnight, you will see that front month disappear. And now tomorrow, you'll log into VIXCentral.com and you will see that the gap between the front month future and the VIX index is once again a fairly large gap, and significantly large. You'll know why. You won't be surprised by it. So starting tomorrow, the VXX, UVXY, and the underlying index are tracking 100% the front month M1 future, which will be, I guess, around, 26, something like that, and 0% of the back month. And then each day that goes by, it will be moving a few of those contracts to the back month. And then next month, third Wednesday, it's going to expire again, rinse, repeat. So we'll talk about this stuff more. I'm not going to expect everybody to get it all right away, but that's the system. You're ready to make a killing short and vol. So good luck, stay safe, keep your position sizes small. Thanks, everyone.